Hello and welcome to episode 7 of Lifespan's investment series. As usual, joining me is Lifespan Investment Committee member, author, and publisher of the Payne Report, Jonathan Payne. Welcome, JP.
Thanks, Eugene, and nice to see you.
Good to see you too, mate. So, following on from our last discussion in October of 2024, where we reflected on quite a number of things, actually, the US election, unrest in the Middle East, the economic tailwind in China or not. And with what we now know about Trump being sworn in as president and the rapid unfolding of his cost-cutting, tariff-heavy economic policies, what do you think lies ahead for continued geopolitical instability, Jonathan?
Well, there's a lot in that opening question, Eugene, as you know very, very well. Yes, January the 20th, we now have Donald Trump back in the White House. And my goodness gracious me. So what date is it today, Eugene? The 13th of February. So it's not even 4 weeks, and it feels like 4 years.
I know.
So he's got another 3 years and 11 months and 10 days to go. And as a friend of mine in Texas remarked to me very dryly the other day, he's already done more press conferences in 3.5 weeks than Biden did in 4 years. Clearly, my friend in Texas is a Trump supporter. But he certainly hit the ground running in this administration. You might remember that when he won in 2016, everyone was flabbergasted because very few predicted it. And when he arrived in the White House in 2017, it was pretty chaotic, to be frank. This time around, he's hit the ground running. So we've just seen a blizzard of executive actions or executive orders, and we've also seen the creation of his new cabinet, and we've seen Scott Bessent at U.S. Treasury. Now, I'm a big fan of Scott Bessent, so I just want to put that out there. So I have a bit of a conflict of interest. I can't be too neutral on this one because, of course, Scott Bessent is a very, very well-known and admired, respected global macro hedge fund manager. So I kind of think about the world the same way that he does. But I think he's a first-class candidate. And then, of course, at state, the State Department, we've got Marco Rubio. So nothing really too much to say about Marco Rubio. We know him incredibly well. Scott Bessent, I think, is as they say in England, top draw, first class candidate. But all in all, it's not just been on the domestic front where we've seen this rapid fire implementation and then lifting of tariffs, 25% on Mexico and Canada, obviously America's two largest trading partners when you add exports and imports together. And I was really quite shocked when I saw that. And I said so in my Payne report that I couldn't really understand it. And then, of course, he rescinded it, 24 hours later. So we got kind of whiplash just in his first few days in the Oval Office. And because, of course, the Mexican Canadians agreed to dispatch 10,000 soldiers to the southern and northern borders. However, the 10% on China, the 10% tariffs on China stays in place. And there's more stuff to happen there. More latterly, he's now putting tariffs on aluminium and steel, one of his favorites. And I think the European Union is next. I know we're amongst friends in this conversation, Eugene, but I don't think it's any secret that Donald Trump really doesn't like the European Union, and he doesn't like most of the leaders. Anyway, so I'm kind of bracing for that next shock. The big conversation, obviously, in terms of the domestic economy is how inflationary will these tariffs be? We've all read hundreds of academic papers. Unfortunately, the tariff debate, like everything in life today, has been contaminated by partisan politics. So we get left-wing academic economists saying that they're super inflationary. Then we have right-wing academic economists saying that they're not really that inflationary. I'm kind of in the middle on this one, Eugene. I think tariffs will be inflationary, but marginally inflationary. And again, it's all about the size of the tariff and also whom is actually tariffed. So if he had imposed massive tariffs on Mexico and Canada, yes, that would have been quite significant because so many goods cross those borders. The automobile industry, as we know, for example, the components that make up an automobile, a car, sometimes cross the Mexican and the United States border 6 times before they actually are put into the final assembly of a car. So imagine that tariff impact. So it's really, really complex stuff. But at the end of the day, I think I'm on the side of tariffs will be marginally inflationary. But I think we can agree, I think we can, that they are disruptive to commerce, to economic goods, and transactions across borders. So net, and this is a big debate amongst the hedge fund community at the moment, is will the tariffs on balance be somewhat stagflationary, meaning dampening economic growth while slightly elevating inflation? And then, of course, there's the geopolitical arena. And Eugene, you and I have lots of conversations about these things. Look, it's impossible to be brief. All I'll do is update everyone listening to this that just not many hours ago, Vladimir Putin and Donald Trump had a phone call and they've agreed to meet. It looks like Trump might be on his way to Moscow. I thought he was going to go to Beijing and meet Putin there. But the bottom line is Trump has elevated the discussion and negotiation around Ukraine. And there's a huge amount of chatter, which I won't get into in foreign policy circles in the last 6 hours, about the meeting between Putin and Trump and how much Trump will give up, how much will he concede to appease Vladimir Putin. This is a big, big conversation at the moment. Oil prices dropped on the news. Oil prices dropped quite sharply because they think that that will mean Russian oil, if there's a negotiated truce, will come back into the market. And then, of course, there's the Gaza, the ongoing tragedy, humanitarian catastrophe in Gaza. And every day we watch, incredibly emotionally, the release of hostages. And it's an incredibly emotional conversation. So the bottom line is Trump is engaged there as well. We all know how. So one of my quick observations, and I know we can't stay too long on the geopolitical affairs because there's so much to talk, for example, about the inflation that came out overnight. But the bottom line for me is when all is said and done in 4 years' time, Eugene, when hopefully we're still having these wonderful conversations, I don't think we'll look back at the Trump administration in 4 years from now and view him as isolationist. Many people in foreign policy circles describe Donald Trump as an isolationist. He is not an isolationist. He's already involved in Gaza, Israel. And of course, I haven't even brought Iran to the conversation yet. We may not have time for that. But obviously, there's Russia, there's Ukraine. And of course, the really big one is the discussion, negotiation, conversation between Xi Jinping and Donald Trump, which awaits us, I think, in the next several months.
Yeah, so really interesting, Jonathan. And there's just so many different pieces to the inflation and market jigsaw puzzle, as you sometimes refer to it. So just going back to Trump and his tariff agenda. So what happened with Mexico was really interesting. He fired off, you could call it now a threat of a 25% tariff. He seemed to get what he wanted from Mexico, and then he quickly took it off the table. And a lot of commentators, including yourself, have suggested that in many cases he doesn't really want to impose a tariff. He's doing it as a bargaining chip to try to get a better deal or a better outcome in terms of his relationship with certain countries. Do you think that is pretty strong evidence to confirm that? And in many cases where he's actually threatening a tariff, there may not actually be a tariff if he can get an outcome somewhere else. What do you say to that?
No, I think you're absolutely right, Eugene. And there's a lot of conversation around this topic because we're all trying to understand, the art of the deal. So yes, Trump uses tariff or the threats of tariffs as a means of leverage to enhance his position in terms of the negotiation. And you're absolutely right. He announced the tariffs on Mexico and Canada, and then had conversations with the new president in Mexico almost immediately. And she offered to send 10,000 troops to the border, and also, by the way, emphasized that they were really, really going to, buckle down on containing the drug cartels, which are sending, vast amounts of fentanyl across the border into the United States. And so basically Trump got what he wanted. So he said, yeah, great. Thanks very much for the call. I'll lift the tariffs. Or basically he said, I will review them in 30 days' time. Yeah. And then Justin Trudeau finds out from the president of Mexico what she said to Trump. And apparently called up and said, "Hey, Mr. President, guess what? I'm going to send 10,000 troops to the Canadian border." And Trump said, "It's funny you mentioned that. I just had a phone call with the president of Mexico. She just offered to do the same." So Trudeau put on the table exactly what the president of Mexico had, and Trump said, "Okay, done. I'm lifting the tariffs." And don't forget, just before that, we had the incident with Colombia, where the president of Colombia. So Trump initially imposed tariffs on Colombia. Why? Because they wouldn't receive or accept illegal immigrants that Trump was deporting from the United States back to Colombia. And initially, they wouldn't allow U.S. military aircraft to land in Bogota. And then the president of Colombia said, "Hey, no, that's okay. I'll send my own presidential jet to pick them up." So he got his way there as well. I'm not so sure about Europe, Eugene. I think he's going to go through with tariffs on Europe, and obviously he has imposed 10% tariffs, which are on top of existing tariffs on China. Remember, Trump first imposed tariffs on China in 2017-18. Biden then continued those tariffs. The Democrats kept quiet about that. They actually maintained all of Trump's tariffs through the Biden administration. While criticizing him for all kinds of things, it's continued his policy. And then, so more latterly, he imposed an additional 10% on China.
It's hard to switch off these income streams for governments once they're there. So yeah, interesting. And you talked about Trump and Putin. Trump meeting up with Putin. I have listened to a few of his speeches, some of the ones that you've recommended, particularly the one in Davos, and yeah, he really wants the war in the Ukraine to end, from what he says anyway. And that is one thing about Trump. He does tend to follow through on the things that he says he's going to do, for all his other faults, and we haven't got time for that today. So watch this space, I guess. Wouldn't it be wonderful? It's been almost 3 years since that conflict tragically began. Moving on from that, let's turn back to the US, and we had a hot inflation number overnight in the US. Jonathan, maybe you can talk us through that and what you think, or how you think that's going to impact the outlook for interest rates in the US.
Yeah, sure. It was a hot number, Eugene. You're absolutely right to describe it as hot. You could even say hot, hot, hot. I'm not sure if that's a song or not. I'm showing my age now. If it is a song, it's probably from the 60s or the 70s. Let's just run the numbers very quickly. We won't get too much into the kind of plumbing of the report, but the number at the headline level was hot, as you say, month on month, up 0.5% month on month. That's for the month of January. I'm going to look at my notes because I've written pages of notes on that CPI release. I think it was the highest monthly increase since August 2023. Wait for a minute. I got it. Yes, the highest month-to-month increase, up 0.5%, high since August 2023. So that's kind of interesting. And then obviously excluding food and energy, we were up a 0.4%, actually nearly rounded to 0.5%. Now that would have set a cat amongst the pigeons. But the actual core CPI, ex food and energy, obviously up 0.4%. So just give you the year-on-year numbers. So annual CPI at a headline level is now 3%, and the core CPI year-on-year is at 3.3%. The previous year-on-year for the prior month was 3.1%. So we're seeing this acceleration. Not only is inflation remaining sticky in the United States, we're actually seeing a little bit of an acceleration in the year-on-year rate. Now, when you break the number down, I mean, obviously everyone's talking about eggs. No one's having omelets or scrambled eggs anymore in the United States. So the highlight that everyone's talking about, eggs in the month of January rose 15.2%. Okay. And on a year-on-year basis have risen 53%. Okay, that's the comical part of the report. The unfunny side of the report is that when you start looking at what the Fed told us, what Powell told us were some of the main things that they look at, all of the Fed's preferred kind of subcategories were all very, very misbehaved. So, for example, so-called super core service inflation, which strips out housing, because of course you might remember Eugene, years ago, I got a bee in my bonnet about owner's equivalent rent, which obviously is the largest component part of CPI. And that's what led to that surge in inflation, was that rent inflation surged. But super core service inflation, which excludes rents, excludes shelter, rose on the month 0.8% on the month. Now just annualize that number. I mean, it starts getting crazy. The other dynamic, which is interesting to note, one of the reasons why we saw such a pronounced deceleration in the rate of inflation from 22 peak, down through the end of 23 through 24, was of course that goods prices went into deflation. We had outright deflation in the month-to-month rate of change in goods prices. We're now seeing an acceleration in the rate of goods price inflation. Now, you've got a problem if service-based inflation remains sticky. Yes, it came down, but it's not falling anymore and is slightly rising, at the same time accompanied by rising goods prices. That's a double whammy. And the Fed didn't have that on their radar. So all in all, not a friendly report. Obviously, the bond market reacted commensurately with a 9-10 basis point spike, pretty much along the curve, 10s up 10 basis points. We also had a 10-year US Treasury auction overnight, and we actually had the highest coupon, 4.625, 4 5/8 coupon, highest coupon on the 10-year note since 2007. Now, it's not the highest yields, because obviously in October 23, we had that real spike up to 5%. That's a yield to maturity. Now, these are the actual coupon rates. And because the auction came just after CPI and we had that big sell-off in bond prices, 9-10 basis point rise in yields, you got a shift higher at the auction on the settlement yield, which was, so the coupon came out at 4.625, highest since 2007. So that was kind of interesting. The bottom line is the Fed will not be happy with the CPI number. Now, I don't want to dwell in too much into the so-called seasonal adjustment factors. Okay. Every month is seasonally adjusted. And what has happened in the last 4 years, that the January number has been somewhat higher than the rest, because a lot of businesses, particularly in the service sector, tend to change their pricing at the beginning of the year.
Right.
Therefore, in the last 4 years, in a period of much higher inflation, service-based companies have generally used the January repricing as an opportunity and an excuse to put in a little bit extra price for the start of the year. And the seasonal adjustment factor the BLS uses hasn't yet sufficiently seasonally adjusted for this new post-COVID inflation world. So there's some saying, it is...
Don't worry about it because it's January.
Because of the January... Yeah, correct. Because of the January effect. So, but bottom line is the market is now pricing just one rate cut by the Fed. Lots of commentary and conversation around the neutral rate. We've spoken about that on our investment committee. We've spoken about this kind of realization that inflation is stubborn, sticky, and that the Fed is basically took a lot of those rate cuts off the table. And the other thing we've spoken a lot about, Eugene, within our team, is, of course, that we've seen 100 basis points of cuts by the Fed, that first one in September being 50 basis points, followed by 2 consecutive quarter point cuts, making 100 basis points, 1%. And at the same time, the 10-year note yield has risen 100 basis points. That has never happened before, apart from a very brief moment in the early 80s. We've had conversations about that, you and I, before. So it's a really interesting environment. And then, Eugene, we have to throw in the mix the tariff conversation. I think it was overnight or maybe the day before, Dr. Larry Summers, obviously former US Treasury Secretary and very influential, he came out, I think overnight, saying that he's very concerned that with tariffs coming down the pipeline, at a time when unemployment's at 4%, average hourly earnings running at an annual rate of 4.1%, at a time when inflation looks like it's kind of sticky and stubborn. Larry Summers is saying, watch out. We could get a bit of an acceleration here in the inflation rate.
Because if we agree that Trump net is going to be inflationary with his tariffs and other bits and pieces, that wouldn't have flown into any numbers that come out yet, right? So that's perhaps something you might see later in the year. So, not a good start to the year. Can I just ask, those numbers that you mentioned earlier, how far out were they from what was expected?
Yeah, okay. So the headline month-on-month increase of 0.5%, the market was looking for 0.3%.
Oh, that's a big difference.
It is quite a big difference. And as I said, the core CPI almost rounded to 0.5. I think it came out at 0.445. If it had come out at 0.45, as you know how rounding happens, they round up to the next decimal. So it was touch and go, and that would have really spooked the market because that would have been another big miss. But anyway, bottom line is, yes, tonight we've got PPI. The fun never stops when it comes to US inflation. I'm not staying up through the night for this one. Producer prices tonight, and that gives us a better insight into the so-called PCE number, which is the preferred inflation indicator at the Fed.
Sure, you'll be up early to see that, Jonathan. So not only was a hot inflation number, but it was an unexpected.
That's right.
Inflation number, which tends to spook the market more. All right, cool. So we only 6 months ago we were talking 4-5 rate cuts, and when we last spoke, I think the projection was 2. Now we're talking 1. Where are we going to be in 3 months' time? So watch this space. So turning closer to home, Jonathan. In October, we reflected on the stickiness of inflation in Australia. Everybody's dying for that first rate cut in Australia. With inflation now, the view of inflation's changed in the last 3 to 6 months in the US, and we've just had a hot inflation number. What do you think is likely to happen next week when the RBA makes its rate decision, and what do you see in terms of interest rates in Australia?
I've got a feeling the Reserve Bank is inclined to cut. The market is shifted now towards anticipating a cut next week from 4.35 down to 4.10. I think Michelle Bullock would like to cut. There is some sensitivity about the potential politicization effect, namely Albanese, at some point not too far away is likely to call an election. The RBA will try and look through that kind of political noise. But at the end of the day, the last set of inflation data effectively gave the RBA more room to cut. And don't forget, everyone else has been cutting a lot. So the Fed has cut 1%. The BOE just cut again. They've had 3 rate cuts. The ECB's done 3 cuts. And the Bank of Canada, they've really been hard at it, cutting rates very aggressively. I think, I can't remember the exact number, but I think they've dropped rates by 1.5%, the Bank of Canada. And a lot of people often compare the Canadian economy to the Australian economy. Look, I think that the Reserve Bank is going to cut rates. I think that's the way of it. Last year, as you know, we had a lot of conversations about the RBA, and we felt that particularly service-based inflation was somewhat sticky, which basically suggested or precluded the potential for a rate cut at the RBA. So, and they didn't cut last year, much to many people's frustration. But I think the RBA will cut next week. And also they've got a little bit of cover because most of the international central banks have been cutting, notwithstanding that we have got this rather hot CPI number. It is only 1 month. And I'm sure the RBA economics team were looking at it just like I was early this morning and going, whoa, that's a hot number, as you said earlier. So, it's 1 month's data. It's a US number. And obviously there's the tariff thing as well with the United States. At the end of the day, I think the RBA is probably going to cut next week.
Okay. All right. Well, we'll wait and see. A week's a long time. in this business, I suppose. But I think a lot of people will be very happy if they do cut. Yeah, I suppose you've also got to remember that we didn't raise rates to as high a level as some of the other places that you mentioned.
Yeah.
So in many places, our rates are still lower than theirs. But anyway, we'll see what happens. So that we've spoken a bit about macro and geopolitics. Let's talk now a bit more specifically about investment markets. What's your current view outlook for the moment on equities, Jonathan?
Yeah, on equities, I'm very, very mixed. I mean, I know that we might have a conversation at some point in our discussion today on NVIDIA and things like that. And people who read my report will know my kind of affection for NVIDIA and all things AI. And the issue with the United States is this whole notion of American exceptionalism. And, it's predicated on some pretty stark fundamentals in a relative sense. And why do people talk about American exceptionalism? Because on the other side of the Atlantic, is a continent that is mired in, zero growth. I mean, recession, really, the recession in Germany, and problems in the UK, the French situation, we know what's happening there. So in a relative sense, the European economic outlook is awful compared to the United States. And moreover, in the United States, you haven't just got the Magnificent One, you've got the Magnificent Seven, all of whom dominate their respective industries. And in Europe, we really don't have anything equivalent. As a friend of mine said to me the other day, Europe is rapidly turning into a museum. Fortunately, there's still lots of people who want to visit museums in Europe. And he was saying to me, without tourism, Europe would be in very, very serious trouble. So the exceptionalism story is the reason why American markets have so outperformed everything else. And if you look at it over the last 5-10 years or so, actually go back even further, last 50 years, the United States has massively outperformed pretty much the rest of the world. And it begs the question that can that degree of outperformance be sustained? And I have question marks about that. Why? Because I think in 2025, the US equity market is on a collision course with the US bond market. And I do think the 10-year note yield in the United States will move up towards 5%. Now, we saw about 9 basis points last night, and we were up 80 basis points from those September lows. I think we nudge up towards 5%. It's not that far away. Now, the last time we were there, we had a little bit of turbulence in US equity markets, if you recall, in October 23. But I think that's the general drift of things. And the other thing, if you actually look at the best performer of US equities in the last several years was the SOX, the Philadelphia Semiconductor Index. And I don't know how many people should be watching these charts. I love my charts, Eugene. But if you look at the SOX index, the semiconductor index, which is really the kind of, poster child of extraordinary US equity performance in the last 5 years, they have not made new highs since July 24. Now we're February. That's a long time. They're quite significantly below their July highs. Now, we know the key driver of the SOX, is, of course, NVIDIA. And NVIDIA, as you know, has kind of run into a little bit of some fairly significant headwinds of late. And then the other thing is, if you looked at the earnings of some of the big names, Microsoft and others, even Apple's being hurt by China sales, reduction in China sales. Don't forget these huge, big so-called hyperscalers are spending vast amounts of money on data centers and the capex related to AI and building out AI capability. And the market's kind of asking the question, hey, you better start monetizing this stuff pretty soon because you're spending, between the three top, whether it be Google, Alphabet, Google, Meta, and Microsoft, the numbers are $65-75 billion on AI-related capex. So there are some question marks there. So look, bottom line for me, I think we're going to have a really rocky, turbulent, bumpy 2025. I think it's going to be a very, very bumpy year, and I'm cautious US equities. If you want to be kind of neutral-ish, I wouldn't get too upset, but I'd still be somewhat cautious. And the other thing, and I know we've had some conversations, Eugene, you and I, on gold and things, but it's really fascinating when you talk to asset allocators around the world. They kind of say, you know, we feel we have to have this money in the United States because it's been such a great performer. But we feel a little uncomfortable because we're so overweight the United States, and we know they're all overweight the United States. And we know that the United States, as a percentage of the underlying international index, is at record levels. So there's this compulsion for, if you're sitting in Liechtenstein or Luxembourg or Brussels or London or Sydney or, I don't know, Toowoomba, you're probably overweight US equities. So there's a lot of money that's already invested there. So I'm somewhat cautious about that. The problem is, if you leave the United States, where do you go? Europe's in a spot of bother, in my view. The earnings outlook, I don't think, is very robust in Europe. And then you've got the whole China question and that whole risk of that narrative around China and geopolitical risk, political risk. Australia kind of sits out there on the edge, and all of us here in Australia hope that no one notices us and that we're kind of kept out of the battle between Trump and whoever he's having an argument with. And we know our Prime Minister had a conversation with him the other day, which apparently went quite well, which kind of surprised me a little bit. But by the way, Trump's always very charming with people. Anyway, and then he puts the phone down and he says something to one of his staff members. Anyway, so yeah, Australia's kind of, you know, we saw CBA numbers yesterday, Eugene. I mean, look at those numbers. They were blowout numbers. I mean, I don't know how they do it, but anyway, they do it. They keep on doing it. But I'm somewhat cautious on equities. I think gold probably has a place in portfolios in the medium to long term. That's another discussion, perhaps.
Yeah.
Bonds. I'm cautious on bonds, Eugene.
Yeah. Okay. Cool. So you're cautious, and I think one of the main reasons, you know, there's always risk out there, but there's a few unknowns. Valuations of equities are at pretty high levels, particularly in the US, particularly around those so-called magnificent sevens. They're not ridiculous, but they're not pricing in a lot of risk. Would that be fair to say?
I think that's fair to say. You know, again, the issue with the US equity story is you've got this Mag 7 phenomenon, but at the heart of that was that Mag 1, the Magnificent One, NVIDIA, which now is trembling. You know, it was untouchable. It was invincible. NVIDIA was the invincible one, not only magnificent, but invincible. Yeah. And, you know, one of the best CEOs in history in a transformative revolution, which is real. And I'm a big believer in AI as being a transformative revolution that's going to impact every aspect of our lives.
Jonathan, turning now to the managed portfolios, the lifespan managed portfolios, want to just have a chat about, you know, how we're positioned and some of the changes we've made in the last 3 months or so since our last chat, and you know, our outlook, I suppose, going forward. We've talked about, when you in your equity discussion earlier, you talked about being cautious. You also talked about there being perhaps pockets of things that are very expensive and pockets of areas of the market that aren't so expensive. And I think one of the areas that we've discussed in the past here and at our investment committee is global small to mid caps, being perhaps an area where valuations still look reasonably attractive, particularly compared to large caps and the Magnificent Seven. And is that's still your position?
Yes. Look, we had these conversations some months ago, didn't we? And an allocation was made to the mid-cap, small-cap kind of sector, and mid-caps have performed admirably. The smalls, actually, if you look at it, they surged initially. They gapped up. Because Trump is perceived as being very positive for smaller companies, and we saw that in the NFIB survey, the National Federation of Independent Business, which do a business survey of smaller companies, and that had the largest month-on-month increase in history when Trump won in November last year, and the smaller companies sector soared. Then you got a bit of profit taking, but the mid-cap sector has actually continued to do quite well. So I think there's a good argument for an allocation to small/mid-cap sectors. There's a valuation argument. Clearly, that sector has underperformed the large cap universe for several years now.
Yeah.
And so you've got some fairly nice tailwinds. And don't forget also, the smaller companies really like deregulation and lower taxation.
Yeah.
So on the Trump menu is less regulation and less taxation. And we also know that smaller business owners in the United States are overwhelmingly fans of Donald Trump. So hence the improvement in business confidence. Don't forget, this sector of the American economy got whacked under the Biden administration. They got whacked. They got whacked by regulation. They got whacked by higher inflation. They got whacked by higher interest rates, and they're ultra sensitive to short-term rates. And so basically there's a huge sigh of relief. They've got their guy back in the White House. They've got the prospect of less regulation, less taxation. And of course, interest rates came down by 1%. So they're quite happy.
Yeah. Yeah. So, and we discussed this at the last discussion, the fact that we added an allocation to global small to mid caps via a fund that we discussed last time. So I won't go into that again. We are considering increasing that, particularly on the tactical side. But yeah, so that's a theme that continues to play out. We continue to watch this space. Some of the other changes that we've made, we've made quite a few changes to our fund manager mix. So we swapped out a small cap manager by the name of Iger, and we've added that to two different small cap managers, Maple Brown Abbott and Ausbil. Both very good long-term names, well-known names in the funds management community. So yeah, we've got a good degree of confidence with those. They're more neutral managers. So we're sort of taking an approach in our portfolios to be a bit more neutral between growth and value, and looking for sort of all-weather type, we call them, managers that have demonstrated they can outperform in environments where growth might outperform value, or value might outperform growth. So we've done that. We've also swapped out one of our core global managers in MFS for the JP Morgan Global Select Equity Fund. It's a hedged fund, so it's hedged back to Australian dollars. And we, track record played a part in that, looking for a fund that was a bit more neutral once again, whereas MFS was sort of a bit more growthy, or growth at a reasonable price type fund. So we made that change. We're looking at putting in a new fund. Well, it's a new fund, but it's a management team that used to manage one of the funds that are already in the portfolio. They basically moved outside and set up a new fund. And so once that's available on the various platforms that we run our portfolios on, we're looking to swap out the previous fund for the new structure with this management team that have done really, really well. And we have a high degree of confidence in. The name of the new fund is the Life Cycle Concentrated Global Share Fund. So few changes around manager. This is all in the strategic portfolios, and we haven't made any significant changes to our asset allocation. We did discuss in our last update 3 months ago that we were considering in the strategic portfolios adding an allocation to global REITs, which we're still considering. That being said, though, that was in sort of September, October when we were looking to do that. The world changed a little bit with at the time Trump was looking to be elected. We sort of had an idea that if that happened, it would change the inflationary outlook, which in turn changes the rate, the interest rate outlook. As you may know, dropping rates is great for REITs, and that was kind of what we had in mind. But now we still think rates are going to come down. We're just changed our outlook in terms of the trajectory. So we're still going to eventually make an allocation to global REITs, but we've sort of put it on hold and we're sort of looking for a better entry point. We're also reconsidering our Australian REIT exposure, largely because it's become such a concentrated benchmark.
Yeah.
And it's done well recently. But we're sort of starting to think maybe for diversification reasons, and if you look at returns going forward, or what we expect returns to be going forward, global REITs might be better. So we're not in a mad rush because it's our allocation's only sort of small and it's neutral, and we're underweight global REITs. But that's sort of what we're thinking. But we're in no mad rush for that. On the tactical side, we have slightly increased our growth exposure since over the last 3 or 4 months, and we'll continue to do that slowly. One of the changes we're about to make is just to reduce the allocation to duration, to bond duration in the tactical portfolios, because it is sort of neutral to slightly overweight. And again, given the medium term, short to medium term outlook, we think that makes sense. But the tactical portfolios, and to some extent the strategic portfolios, still remain moderately underweight, because of all the factors that we've talked about today. There's a lot of risk out there. There's a lot of good reasons to be underweight. Valuations are extremely high, and some of the other factors that we've talked about today. But we're well enough invested to be getting most of the upside, and you can see that from the returns. We're also trying to be a bit smarter about the sectors that we allocate, because there is still value in some areas. We've talked about global small and mid cap, and it also matters where your allocation is within global and Aussie equity. So that's kind of an update of how the portfolios are positioned, what we've changed in the last 3 months. As I said, from an asset allocation point of view, we haven't done much over the last 3 months. It's mostly been some reassessment of a few managers and some changes there. Jonathan, did you have anything you wanted to add to that?
No, I don't think so. One small observation. I don't know how many of the people watching this will be going to the Market Summit, the Portfolio Construction Summit, but I've been playing around with a lot of thoughts about how it's so, as you know, Eugene, better than anyone, you'll know how difficult it is to summarize one's thinking. And market summits, they always ask you to try and condense it into 20 minutes, which I find impossible. So I'm one of the very few people, by the way, don't tell any of the other speakers. I'm usually allowed a little bit more extra time than they are, because I waffle on for so long. But one of the things that's running around in my head at the moment is that there's this there is this overwhelming nexus between politics and economics, and that return of Trump to the White House brings politics back into the conversation around economics, markets, because it's tariffs, it's geopolitical, it's what happens to oil prices if there's something with Iran, etc., etc., etc. Now, I think one of the things that all of us need to spend more time on, and I'm obviously, this is to my advantage, we're going to have to incorporate more and more political and geopolitical analysis into the formulation of our decision making. And I think Trump is a reminder of that, because he brings politics front and center back into the whole conversation around economics.
Well, absolutely. I mean, the whole outlook on interest rates and inflation changed.
Exactly.
Didn't even have to wait for him to be elected. It kind of changed when he became a strong favorite. I mean, I don't think too many gave Harris that much of a chance, maybe a month out,
Right.
So yeah, 100%. And as we touched on earlier, he's very active. He's out there. He's not mucking about, and it's his last term.
Right.
So
right.
he doesn't care about re-election. I don't know that he really, I think he just says things anyway. But we know that doesn't have to worry about being re-elected. So
Right.
he's going to be active out there for better or for worse. And on that note, Jonathan, we might leave it there. It's been a wonderful discussion. Thanks again for your input. And thank you to everybody for tuning in. And thanks for your support. And just a reminder, if you've got any questions, contact your Lifespan advisor. And if you don't have an advisor, go to our website and there's a way to make an inquiry, and we can put you onto one of our 300 advisors. So thanks again for tuning in, and all the best.